Hi, people. Thank you for stopping by at Building Wealth with Rajiv, and welcome to episode 4 of Stock Market and Investment Beginner Series. In this episode, I'm going to cover three things. Number one, how market normally prices the stocks, various methods they take. Number two, which is my preferred method of pricing the stocks based on my experience, based on my gains, losses, and various investment education courses I've taken. Number three, which method you should avoid, which can limit your gains. Now, my request is to get the full benefit, you should stay till the end of the video. It's not a very long video. And at the end of the video, if you like it, please smash that like button, subscribe to my channel, share it with your friends for the broader benefit. Now, a bit of housekeeping and a bit of basics here. Valuation is a very contentious topic, as I understand. And there are two extreme schools of thoughts. One school of thought, which don't care about valuations. The only thing they care about is strong business and strong fundamentals. Buy a strong business, strong fundamentals, keep your holding period for a decade or 5 to 10 years. As the price goes down, it's a great opportunity to accumulate more stocks or more of that great business. Now, second school of thought, valuations matter. You cannot rely on the market to price the stocks. Market is irrational, it's imperfect. So you've got to have certain idea or you've got to price the stock properly to maximize your gains. Now, let us begin with looking at this chart. Now, this shows the life cycle of the company. I've used this before in the training session as well. Now, how the stock should be valued has to be looked into this context. This is extremely critical. I can't emphasize the importance of this. You will miss out many opportunities if you don't take this into account. A company just beginning its journey cannot be priced the same way as an established or matured company. I've learned this simple truth with experience. The investing courses which I took a couple of years ago did not teach me any of this. Now, typically, the pricing measures you may have heard of is price to earning ratio, PEG ratio, which was popularized by Peter Lynch, legendary investor, enterprise value to EBITDA ratio, price to sales ratio, and last but not least, there are discounted cash flow methods, discounted dividend model, and discounted earning method. There would be various more methods, but these are the typical ones which are here, typical ones used by the Wall Street and brokerage houses. Now, in my view, company's ability to generate cash flow over a period of time is the most important indicator. If a company is not able to generate cash flow, it's not able to survive. Now, let's hear from genius investor Warren Buffett what he thinks about valuation and how he calculates it.
If we could see in looking at any business what its future cash inflows or outflows from the business to the owners or from the owners would be over the next, we'll call it 100 years or until the business is extinct, and then could discount that back at the appropriate interest rate, which I'll get to in a second, that would give us a number for intrinsic value. Businesses have coupons that are going to develop in the future too. The only problem is they aren't printed on the instrument, and it's up to the investor to try to estimate what those coupons are going to be over time. As we have said, in high-tech businesses or something like that, we don't have the faintest idea what the coupons are going to be. When we get into businesses where we think we can understand them reasonably well, we are trying to print the coupons out. We are trying to figure out what businesses are going to be worth in 10 or 20 years. When we bought See's Candy in 1972, we had to come to the judgment as to whether we could figure out the competitive forces that would operate the strengths and weaknesses of the company and how that would look over a 10 or 20 or 30-year period. And if you attempt to assess intrinsic value, it all relates to cash flows. The only reason for putting cash into any kind of an investment now is because you expect to take cash out, not by selling it to somebody else, because that's just a game of who beats who, but in a sense, by what the asset itself produces. That's true if you're buying a farm, it's true if you're buying a business.
I hope you have heard what Warren Buffett said well enough. I would request you to hear it a few more times. Every time I hear, I learn something more. Now, after hearing the genius, we know that discounted cash flow can be used as a starting point for valuing business. Now, that brings me to the next things. Whether this can be applied to all the businesses or company, the answer is no. You've heard Warren Buffett talking about not able to decide risk-free rates and predict the tech business. So clearly, predictability of business is a key factor if you want to start with discounted cash flow method. Businesses which are new and growing or have a lot of optionality is very difficult to estimate the future cash flows. Now, imagine valuing Amazon in 2000 on discounted cash flows. It started as an online book company, became online retailer, became a cloud giant, now going into health, pharmacy, streaming, and whatnot. So for such businesses, discounted cash flow method could be like a telescope. You shift it to left, there's one picture, and when you move to right, it changes. Many of these companies don't have earnings too. So the key takeaway here is the discounted cash flow method could be your starting point for predictable businesses. Example, Apple or Unilever or P&G, where the income streams are more or less known. They will evolve. I mean, no method will be perfect. Discounted cash flow will not be a perfect method, but it will be a good approximation for such businesses. Now, you got to definitely need to triangulate this with quality of business before making any investment decision. Now, what should be the starting point for growing businesses? I'll go into that. But before that, I would like to touch upon PE ratio, something which is very often quoted, and it annoys the hell out of me. Let me show you some examples. Now, this first example is of Tesla. You can see that the company did not have any earning from 2011 to 2019. And in 2020, it had price to earning ratio of 1,428. Now, I've compared it to S&P 500, which is far lower price to earning ratio. Yeah. Now, if you look at these two measures, you would say Tesla is not a good investment. Buy S&P 500 index or buy a similar company like that. But look at the stock chart of Tesla. In last 10 years, the amount of returns Tesla has given is extraordinary. Now, let's move to another example. Sea Limited. Again, the same story. The company is not making any money simply because it's investing, it's reinvesting all what it's making, all its gross margin into growing the businesses, and therefore has no earnings. If you compare it to index, it looks fairly expensive. A lot of conservative investors will not go into that. And look at the chart below. Look at the stock returns the company has generated. I'll give you another company, another example, which is Shopify. Look at the price to earning ratio of Shopify over 7-8 year period, and then look at the stock performance of Shopify. Another example, Amazon. Now, this is a company which is very well known. Look at 10 years history of price to earning ratio. If you go by price to earning ratio, you will never buy Amazon, and you will miss out on one of the most iconic stocks in the history of stock market. Now, I'll just contrast it and give you an example of Intel. Now, look at the Intel price earning ratio and compare it to Standard & Poor. Now, Intel looks cheaper. Now, anybody who's a big fan of price to earning ratio will end up buying Intel. And look at the stock returns of Intel. So, fellow investors, next time if somebody talks about PE ratios to you, please run in opposite direction as fast as you can. Now, how to get an idea on valuation of these growing businesses? I would suggest using price to sales ratio as one of the key measures to evaluate a company. Why sales are important? Now look at this data, look at this chart, and you can see that based on past several years of data, revenue has been a top driver of share price growth. Let me give you some more examples. Here is price to sales ratio and revenue growth of some of the leading companies. Now, I'm not going into the definition of price sales measures and other valuation measures. However, I've explained them in the description below. Now, picking company here is a bit subjective. For me, if I'm very happy with company management, business models, and company is on the right side of secular trend, I'm okay as long as price to sales ratio is half or 1/3 of revenue growth. Now, I want to emphasize again, valuation is the last thing. The key components are quality of businesses, management, etc., etc. Now, going back to these companies, from these measures, Sea Limited and Tesla, they are a go. The key question is, what do we do with Shopify here? Now, it's a great business. There is a strong case that it is possibly a generational company, which is fueling a new ecosystem. Now, that's something numbers can't capture. So it's a bit of a difficult decision. Now, there is an argument that such high performers can continue to remain high performers. And if I'm new to building a portfolio today and looking for an anchor stock, I would definitely pick Shopify and buy it again if the price goes down. Now, in my existing portfolio, I already have Shopify. So I may prefer a C Limited or Tesla over Shopify because they're also great companies, but they're far more available. They're available at far better valuations. So my upside could be higher. Now, I would like to summarize. For established, predictable businesses, stick to DCF as primary measure. For growing businesses, take price to sales as the starting measure, as the primary measure, and say no to PE ratio. Also bear in mind that your starting point is the quality of business management and quality of other commercials. Valuations comes in last. Another thing that you can use to your advantage is using Wall Street estimates. Go to www.tipranks.com and you'll see what Wall Street is thinking. I'll look at this consensus price and gauge what I'm paying. However, my own research and conviction is more important. At times, consensus price says don't buy, but I still buy because I believe in the company and I buy more when stock prices go down. Now, I would like to summarize one thing and emphasize again that the valuation isn't an exact science as it's made out to be. It's both logic and magic, that is science and art. There is good amount of judgment. Now, I understand that having a fixed answer is easy. However, that doesn't seem to be reality. And knowing that and mentally preparing yourselves will give you a huge, huge power and advantage in stock market. And by the way, here are good sources of data. You can find everything from, and some of them are free, some of them you need to pay if you need some advanced information. You can go to Morningstar, you can go to YCharts, go to Yahoo Finance. And last but not least, just use Google search engine for many of these. And most of the time you'll get the right info. So investors, fellow wealth builders, I hope you enjoyed the session. You found something new, some new education out there. If you like the channel, again, just follow it, share the information with your friends, and I'll see you soon. Thank you.